Welcome to the Stock Health series. In this series, we are going to look at certain parameters and get to the final health score of the stock requested by you in the comments section. Today's stock is TCS, which was requested by one of our wonderful subscriber. It has market cap above 11 lakh crores and stock price around 3,200. TCS has diversified itself in many major businesses. Estimated growth rates for businesses is as follows. Its estimated revenue CAGR comes around 7% annually. So we have a business model score of 7 out of possible 10. In case of liquidity, let's look at these three parameters. Debt to equity is long-term plus short-term borrowing divided by equity, which in this case comes 0.099, which is very close to 0. Debt to equity is good when it is low, which is great in this case. Interest coverage is earnings before interest and taxes divided by the interest portion of the profit and loss statement. In case of TCS, it is 94. It should be higher than 1, which is way higher here. Let's see current ratio. Current ratio is current asset divided by current liability. In this case, it is 2.32, which is good as it is higher than 1. So we have liquidity score of 5 out of 5. For activity score, let's look at the cash conversion cycle, which explains a lot about cash and product management simultaneously. In cash cycle, cash goes out to the supplier, who provides raw material to the company. Raw materials are processed to the final product, which sits on the company's inventory. The product is then passed on to the customer on credit or on an instant cash basis, which is then received back to the company. Ideal time to complete this cycle is -30 to 180 days. You will get to know about this in a moment. Cash conversion cycle is days of sales plus days of inventory minus days of payables. Days of sales is time required by customers to pay. Days of inventory is time taken by products sitting on inventory. And days of payables is time taken by company to pay to its suppliers. Days of sales is receivables by revenue multiplied by 365. Days of inventory is inventory divided by cost of goods sold multiplied by 365. And days of payables is payables by purchases multiplied by 365. After calculating this for TCS, we get 84, 0, and 32 respectively. Ideal values are mentioned on right side. Inventory's best figure depends on industry and product. Being a software company, there is not much inventory as the major revenue generation is from providing services. So the cash conversion cycle for TCS is 52 days. Which is great, so we have an activity score of 7 out of 10. For profitability score, we will be looking at NPM, ROCE and ROE to see the efficiency of the company to generate profits out of current available capital and assets. Net profit margin is final profit divided by revenue. In case of TCS, it is 19.11% this year. Return on capital employed is calculated by profit before interest and taxes divided by total assets minus short-term liability. For TCS, it is 62%. Return on equity is profit by equity, which is also known as shareholders' funds. For TCS, it is 51.49%. Considering the last 5-year trend for all of the above ratios, TCS gets a profitability score of perfect 5 out of 5. In terms of governance, promoter holding and pledge percentage are very important. Here we do not have issues as promoter holding is above 70 and there are no shares pledged. So in case of governance, TCS gets 9 out of possible 10. In statistics, a metric called standard deviation is used to figure out how stable or consistent the values are. Lower values of standard deviation symbolizes most stability. In this case, we will be running standard deviation on last 5 years data of NPM and ROCE, which come out 0.44 and 4.72 respectively. So, we reach a score of 4 out of 5. In Miscellaneous Score, we will be looking for other pros and cons of the company. In TCS's case, they have good dividend structure, but their PB ratio is little high. So we have a miscellaneous score of 6 out of 10. Revenue growth in terms of compound annual growth rate for the last 3, 5, and 7 years is consistent around 9 to 10%, which is quite good. The estimated growth for revenue for the next 5 years is around 8.5%, which is pretty decent. So the growth score comes 12 out of possible 15. Price to sales is a good ratio to find cheaper stocks quickly. Generally, cheaper stocks have PS lower than 5. It's calculated as market cap divided by revenue. In our case, it's as 4.52, which is good. Proper market value is calculated by justified earnings multiplied by adjusted PE. In TCS's case, justified earning is 49,511 crore, which is multiplied to the adjusted PE according to 8% growth, which is 28. So we get proper value as 13,86,000 crores, which is quite closer to its actual value. Which proves the stock is slightly undervalued. By estimating future value using CAGR, NPM, and PE, we get a forecasted value of 20,75,000, which is approximately 75% possible returns in 5 years. Hence we reach at a score of 20 out of possible 30 in valuation. So after evaluating all the points, the final score for TCS is 75 out of possible 100. You can pause the video for a summary. This video is only for educational purposes, not to be taken as investment advice. Do your due diligence before taking any investment decisions. Leave a comment about which stock would you love to see video on next.